Hello, everybody. John Blank here, Zacks Chief Equity Strategist and Economist. Today is Monday, November the 18th, 2024. What I'm going to go through today is our winners from our Zacks portfolio construction style. So those of you who have been following these Zacks Professional Services videos for some time will find out, of course, that we've been going through sectors as a way of organizing stock picks. Industries are half of what delivers a return. So you get a hot industry, you pick a hot stock, you make more money. It's what this is all about. So today we're going to get into how to make even more money by constructing a portfolio in the right screening criteria based on its sector. For example, part one, we'll get into conglomerates. Now, conglomerates are what they are, an assemblage of businesses that managers put together, or the executive team. And it turns out the number of analysts that are covering that sector really is the winning criteria. That makes a lot of sense because conglomerates are tough to read through, and an analyst can bring you a lot of value, literally value, in terms of returns in the conglomerate space. Part two and three, we'll get into aerospace and oil and energy, and it turns out to be the Zacks Rank criteria, largest forward estimate on percentage earnings growth, is the winner, and it's going to win big. Now, this is a space that has giant companies, so you're going to get, a kind of a index, S&P index return out of this sector unless you play hard the Zacks Rank in this space and find the big winners. And by big winners, you can really, really play a stronger hand in this space. Part four, we're going to talk about computers and technology, and surprisingly, perhaps not surprisingly, for those of us who watched the Mag 7, as they're called, the Magnificent Seven, is market capitalization does win in computers and technology. So we're building giant companies. Yeah, in some respects, they are conglomerates. And in the future world, we might find out they all get broken up because they are just conglomerates. But at this point in time, Wall Street M&A has built the computer and technology system, and market capitalization does win. So keep in mind, these are the views of me, John Blank. I do have a PhD from MIT in economics, and they are not necessarily the views of the company Zacks Investment Research. I'll let the rest of this be read at your leisure. So first of all, we're going to get into conglomerates. Of course, it's a name, and you say, oh, well, I don't know what's in conglomerates. Well, think about these names. Danaher, ticker DHR. Honeywell, ticker HON. Hitachi, HTHIY. 3M, of course, the 3Ms. Markel Group, which is a conglomerate of insurance businesses. And Carlisle Companies, CSL. Probably don't know MKL and CSL. Probably do know all those other names because they're big ones, and some of them in the Dow Industrials. So, again, of course, down here, Markel Group and Carlisle Companies. Keep in mind, we're going to construct three portfolios, one the equal weight, one that's going to overweight Danaher and Honeywell, and one that's just overweight Markel and Carlisle. So this is what the strategy is. We're going to get weighting stocks into three portfolios. Here's your equal weight, here's your overweight, and there's your overweight. So this is going to be your equal weight in the front. Here's your cumulative returns over the last 8 years. As you can see, the big stock here was Carlisle Companies, and Danaher was second, and Hitachi was first. So these were the names that you had to play out. This over here is kind of a noisy area, but it's basically telling you how the different portfolios worked over the last 8 years, month to month. And you can see it's giving you an idea that, you got a lot of volatility. Get negative months, and then you get positive months over time. It plays out for you. But if you don't understand the volatility of stocks, you're really not understanding this business. So first of all, I just put in a red line the compound annual growth, annual returns for these groups, 15, 16, and 14 and a half. So keep that in mind. That's what our base will be. Now we'll go on for market capitalization to the number of analysts. And look what happens. I picked up Griffin, ITT, Federal Signal, and Bunzl in this covering analysts. So they're more interested in those stocks. Why are they? Well, of course, ITT delivered more annual returns. Federal Signal was classic. And Griffin really worked out too. So what happens here with this number of analysts criteria is you do raise the equal weight from 15% here to 20% here just because you pick better stocks with this criteria. So I will star things that are performing best amongst the strike criteria. Now we look at the forward 12-month estimate for the earnings estimate. Again, you're going to see we don't get a very good return out of doing it in this particular space. I think that is because there's not a good read-through of conglomerates with this estimate because we can't see the underlying businesses as well. I think that's probably the answer here. So the last of the four criteria, the 1, 2, 3, 4 up here, will be combining all three criteria and doing it all again. Again, here's Hitachi. And of course, I get pretty close. I get 19%, but I don't get 20%. So I will tell you, as I've said, your best criteria is this one in this space. So let's get on to aerospace. What do I mean about aerospace? Okay, names, ticker RTX, that's Raytheon United Technology. They're now called RTX Corp. Lockheed Martin, of course. EADSY, that is Airbus over in Europe. Boeing, BA, of course. GD, General Dynamics. And TDG, TransDigm Group. We'll have plenty of others here. This is what we consider aerospace, big, giant aerospace companies, often defense related. Stocks by market capitalization, of course, here's RTX and here's EDSY, EADSY, and they're right in there. You can see that. Now, on an equal weight basis with these big names, again, what's the best one? TransDigm Group. But even including it, I can only get a 15% return out here. As you remember, we get 20% returns out of conglomerates. Now we're at 15% only using market capitalization. What happens when we go to the number of analysts? It gets worse. We added in Hunting Ingalls, L3 Harris. So Leidos comes out as the best stock in this particular grouping, but the equal weighting is now down to 13%. Not as good. Obviously, S&P 500 is doing an 8 to 10% annual return. You did better than this, but you can do even better than that. Look at this. Now we've got the largest forward estimate. We put it Embraer and Curtiss-Wright. Embraer is ERJ, Curtiss-Wright is CW, TransDigm Group is in there. HEI and HII are in there, and look at some of this DRS, phenomenal stock we found. And that one stock that we found, DRS, is going to take us up to 25%, 26%, and 21% annual returns. And look at how much smoother it was actually, too, over time. Kind of crazy. This is what happens. We found out that using this estimate revision improved our returns dramatically. It's not marketing literature, folks. You can see that yourself. Okay, those are the top three criteria back to that 20% level. Let's move on to oil and energy. China coal, Canadian Natural Resources, EOG you might know, Equinor you might know, and a few of these other names, Total Energies, TTE, we will also get into. So this is going to be all kinds of different energy plays as well as oil plays and coal plays and things in solar, things like that. So keep in mind, this is a broad net and we're capturing a lot of stocks. Here we go, China Coal and Energy, Canadian Natural Resources over in here. And what do we get out of this in an equal weight basis? About 14%. It's good. Market capitalization works pretty good. And we can see, China Coal was our leader here. That's as best as we can do. Of course, manufacturing coal and steelmaking is done over in China now. Number of analysts. Totally different set of names here. Alliance Resources. First Solar. This ticker Enphase was really a phenomenal stock. 8,000% return over the last 8 years. God, don't you wish you own Enphase? This is the point of picking stocks. You can find a stock like Enphase and kill it. Number of analysts did pick it up. Enphase was huge. Coterra, PBF, and Delek were our other names. Some of these were really poor performers, didn't work very well, even though people were covering them. However, because of Enphase, look at what we get out of annual returns, 140 to 120, 160%. One stock, one thing that worked. It really was incredible. Of course, over here, we get it again. We get these names again. And of course, the one big hitter does the job. And were off the charts with better returns. Phenomenal story. Zacks Rank. Or in this case, pretty close with this one, but it's so weighted by all these other names. This Enphase is just such a big player. I put out this one as the better one than this one. They're close though, folks. They're real close. On to the next one. Read three criteria. Now, basically, as you can see, we're not back to fairly low space. So you can really see in this space, if we use the Zacks Rank, we've got a better return on our investment. Apple, Cisco, Microsoft, Google, NVIDIA, Avago, these are big names. You probably know these names. So if we look in this space, yes, of course, you're going to get 35%, 40% returns with Apple, Cisco, Microsoft, Google, NVIDIA, and Avago. Some of these names, of course, NVIDIA was just gigantic. By the way, close to Enphase. And you pick up one of these big names, get it right, it's just phenomenal what happens to your returns. And you can see it really makes a difference when we get NVIDIA overweight, which is portfolio 3, you're going to get a 40% return versus 30% with equal weight. It's all NVIDIA here. Nobody's surprised by that. But look at these stocks you picked up here. Apple, 760% return over years. Avago, almost 1,200. Incredible length of reach. Cisco is the least of it, getting you about 8 or 12%, the standard portfolio return. All right, number of analysts, a little less, not as powerful because we didn't pick up NVIDIA, which was the market cap winner, of course. And of course, largest forward estimate actually doesn't work as well. What do we pick up here? UMA, Saragon Networks, KT Corporation. So we picked up in this space some names that didn't really work. I think a lot of this is because a lot of these are getting upgraded from negative estimates to less negative estimates, or they're getting upgraded in terms of kind of some curious numbers of covering analysts when you get outside of the United States like KT Corp. But this frankly didn't work. And you can see for all these things that we're back to number one, market capitalization in the infotech space. This should not surprise anybody. The Mag 7, right? Magnificent 7, the big mega cap stocks are tech stocks. And this has been the case for this space. So I'll finish up here with one last slide, which is a combined set of tickers. Hitachi, NVIDIA, Avago, TransDigm Group, China Coal, Canadian Natural Resources. So we just combine all these stocks from these four sectors. What do we get? Let's wrap this up. Pretty doggone good, man. I mean, 35% returns, again, driven mainly by NVIDIA. But if you get all these returns up, look at this. If we get the companies right in each space, we can get a 35% annual return. That is the point of all this, more than anything. If you're using these systems to get the better stocks, you can get a 35% annual return, folks. I mean, at the end of the day, this business is about making money. And if you think you've wasted your time today or waste your time with Zacks, just look at those returns of these 8 stocks. They're all 4 sectors, 2 from each. The better stocks. And if you pick the better stocks, just stop and think about it. 35% annual returns is what you're going to get, not a 10. That's a triple over what you get in the S&P 500. So that really is the gist of these efforts on YouTube, and I want to thank you for attending. I am the Chief Equity Strategist and Economist at Zacks, and this is done for Zacks Professional Services. So if you want to get a hold of these slides, of course, this is data stuff. I'm not trying to win any Emmys or Oscars with this type of thing. I'm doing this for people who want to pick stocks and find the better ones. It's really that simple. Call us, 866-794-6065. Send us an email, strategycall@zackspro.com, or find us on the web, www.zackspro.com. That's it. We got a LinkedIn page, Zacks Professional Services. You can find us on Twitter at ZA Tools. At the end of the day, you want to get a hold of these slides from us. So call us, send us an email. find us on the web. That's the best way to do it. I hope you enjoyed it today.